We are live now.
Good afternoon, everybody, and a very warm welcome to this afternoon's special event lecture. This afternoon, we have speaking to us Dr. Adolfo Paolini, who is the Reader in Commercial Law and Director of the LLM programs here at the University of Buckingham. One of my colleagues, and I'm pleased to say one of my friends, and so I'm very excited by this afternoon's event. Adolfo is co-author of the prize-winning book, Directors and Officers' Liability, and has written extensively in the area of commercial law. He's also an insurance law consultant to the international law firm Clyde & Co. LLP. This afternoon, he will be talking about the impact of COVID-19 on the corporate insurance market, which I'm sure is a very exciting subject that is interesting to all of us at this time. After the lecture is finished, the talk is finished, Dr. Patricia Covarrubia will be chairing a question and answer session. You can put your questions in the little question panel that you can see. Hopefully, if you click on the little question mark, you can put them in there, and Patricia will be moderating the questions and putting them to Dr. Paolini. So without more ado, I would like now to hand over to Dr. Adolfo Paolini.
Thank you, Sandra, for your kind words. Hello, everybody. I would like to begin by saying that I'm very grateful to the law school for giving me the opportunity to talk about this topic, which is very close to what we are facing, and also with my areas of research and practice. I decided to combine for this 1 hour session the effects of COVID-19 in the corporate insurance market, but I'm looking at one specific financial product. You may understand that insurance is a very large section of the financial sector, and it will be impossible to cover all possible products in this short period of time. So when I say corporate insurance market, I mainly refer more specifically to one product called Directors and Officers Liability Insurance. And I wanted to be as positive as possible. I don't know if I have achieved that objective with such a statement, the cruel reality of facing the unexpected, but it is a cruel reality. Most insurance carriers, if not all of them, have been experiencing severe claims, severe losses following this pandemic. There are two areas in insurance connected with corporate law. One is business interruption insurance. Then imagine the losses that the market is sustaining at the moment following the lockdown and the government decision to implement lockdown restrictions to these businesses. And those businesses have in place business interruption insurance. The claims in that area run in the millions and millions of pounds. In fact, last month, the United Kingdom Supreme Court decided a case on that area of law, distinguishing or ascertaining what in reality caused the lockdown. Was it the pandemic effect of COVID-19 or the government decision to restrict circulation and the gatherings of people? Of course, the United Kingdom Supreme Court went and benefits to a certain extent businesses. The other area of insurance law that is affected, as far as I understand, is that part of professional indemnity insurance that covers directors and officers' liability. Why? Because claims, and I have today 4 examples for you to have a look, claims have been brought against companies for decisions that directors have made with good or bad intentions. Nevertheless, there are insurance policies in the background covering those liabilities, and the market is experiencing the effects of these cases, effects which have resulted in hardening the market, increasing premiums, decreasing liabilities, indemnities, and so on, as we are going to see. So I have decided to divide the presentation, let's say, in 2 or 3 parts. The first part is just stats, numbers that you will see, and we will assess what is the impact in terms of real numbers to the market. The second part is a brief explanation of how the directors and officers liability insurance, especially D&O, as we call it for short, D&O policies, operates, and the third part, case law, and whether or not these policies may or may not respond. Some numbers. The first one is the one I highlighted already, the business interruption and contingency insurance. But please, for the purpose of this presentation, concentrate on the second. And especially to the right-hand side of the illustration, which says the claims impact is, and this is Q3 2020, between 0.6 billion and 4 billion loss across US and Bermuda markets. We are not quantifying here UK markets, we are not quantifying European markets, nor Australasia markets, as we call Australia and New Zealand. It's a significant increase in claims in such a short period of time. Basically, we are talking about the end of Q1 in 2020 to the end of Q3 in 2020, and I have no factor in the last quarter 2020 and the first quarter in 2021. Looking at some reinsurance stakeholders in Europe, and I brought 4 European or big important European ones. You will see on the left-hand side the losses that caused in Q1 the COVID-19 and what the repercussion of these losses is in terms of increasing liabilities and decreasing the value of the shares in those companies. Swiss Re, from 1.5 billion losses in the first quarter, went up to 1.6 in the following one, with an increase of 6%, affecting 5.5% of the share price. But incredibly, happened to be Munich Re. Incredibly worrying. Why? Because for 1.4 losses to up to 2.5 billion, that means a 50% increase in the losses sustained or faced by these, probably the largest reinsurance company worldwide, affecting 5.8% of the market. Others, smaller players like Hanover Re and SCOR, sustained losses, but not as dramatic. Albeit, in terms of percentages, Hanover Re is facing 16.7%, that rate. This leads to some early conclusions. The first one is that losses increased between the end of June and the end of September 2020. There is a recession environment around everybody, and this is affecting the market appetite. When I say market appetite, in terms of insurance, it means insurance companies are unwilling to offer or develop new products, and they are very skeptical following the dramatic effects of the pandemic as we speak. Consequently, there are the lack of claims. Most businesses are waiting until the pandemic ends in order to ascertain exactly what the extent of the losses are. Some claims have been notified to insurance companies. Other claims are just young enough or not old enough or haven't matured into proper claims in courts, but claims, no doubt, are coming. The figures I share with you are on reported or incurred but not reported basis. That means this is what insurance companies are reporting to the market, no losses that the insurance companies have already sustained. Further losses are expected. But there are 2 more features that have caught my attention. The first one is, in the middle of this pandemic, probably the 2 largest brokers in this area, of financial services, Aon and Willis Towers Watson, decided to merge. And this is one of the largest mergers that you could ever expect to take place. As we speak, and I read this today, the merge is in the region of 30 billion American dollars. They're just splitting some businesses in order to avoid breaching competition rules. And another thing that I have attracted my attention is that, and I am privy to that information that I receive on a daily basis, there is a huge migration of workforce among the big companies. Every day you see chief executive officers, financial officers, and so on moving from one company to another. So they are recruiting talent across the sector in order to face yes, the right word to say is face the cruel reality of what the market, the insurance market is suffering as we speak, and they need the right people in the right places in order to alleviate the effect of the pandemic. This is in terms of premiums. Now you'll see from 2001 up to quarter number 3 in terms of millions of dollars, billions of dollars, what the directors and officers liability insurance premiums have been. And you see a peak of 1.9 billion in quarter 3 2020, and this equals probably the market price in 2003, 2004. Now, we are comparing this situation to that happened in 2003 and 4 with the WorldCom and Enron scandals, when D&O insurance policies were very, very hard to buy and very expensive to pay. Then the system went down somehow between 2007, the pricing, sorry, went down 2007 and 8, following the financial crisis, is still high at 1.32 billion. And then a period of calms between 2017 and 18, and now it's picking up. I'm quite sure that if I find soon the result for quarter 4 2020 and quarter 1 2021, I'm quite sure it's going to be higher than 1.9 billion. So prices in this area, premiums, are going up. Consequently, the market is hardening, and that means insurance policies are difficult to find or difficult to agree upon. Premiums are going up. Deductibles and retentions are going also up. That means the amount you need to cover as a self-insured before making a claim. Limits of indemnity are stable, so companies are not willing to offer more cover to insureds. Some market players decided to end D&O products, like for example, Argo Syndicate 1200 put the D&O book in run-off, which means in insurance law that they are going to wait until these policies run out of time, but then they are not going to underwrite new policies, and they are not going to renew the D&O policies in the future. Argo Syndicate is a very big player in Europe and Australian market, so we are waiting to see what the effect of this is. Other insurers are spotting an opportunity like SCOR, for example, and they're exploring in the D&O market in 2021, opening first in US and then offering or underwriting insurance in the United Kingdom. To show you in terms of specific examples how the market operates, with the permission of insurance or the insurance insider, I'm bringing to you Shop Insurance, one specific insurance company. And these are features of the new businesses they underwrite. The first one at 12 o'clock, Shop increased 100% premiums from new and existing small and medium enterprises. So everybody, not only the new customers, but also the old ones, experienced 100% increase in premiums. They reduced from 20% to 15% the broker's commissions. They are not offering new policies to companies in financial distress. So as soon as companies disclose what the financial situation is, Shop will reject the company. And this all applies regardless of claim history. It doesn't matter if you have been good or bad insured. This applied across all the portfolios. The minimum deductible in shop is £25,000 and the maximum level of coverage is $6.27 million. That means the market is hard. Premiums high, high deductibles, very small limits. I really hope that you understand that 6.27 million for a big company is virtually nothing in terms of directors and officers' liabilities. But this is just a reaction to COVID-19. However, not all companies are suffering, and one is the envy of the corporate market. In 2003, when the SARS outbreak took place across the United Kingdom and worldwide, the severe acute respiratory syndrome, SARS. And this outbreak cost the life of 8,000 people worldwide. And then the Wimbledon companies, or the All English Club, tennis club, was advised to purchase pandemic coverage. And they decided to do so at a premium of £1.5 million per year. And they paid £1.5 million for 17 years, so a good 25 million in premiums. Last year, for the first time, after the since the Second World War, Wimbledon did not take place, but Wimbledon was insured. And they claimed 174 million from the insurance companies. Obviously, the insurance companies are not that happy, but they pay pandemic coverage for £25 million. If you compare with other tournaments, the other 3 Grand Slams in tennis, the Australian Open took place because it happened before the lockdown in January 2020. But the US Open, the Roland Garros after, and the US Open after Wimbledon had to go ahead because they did not have insurance. And the monies that they're going to lose in terms of TV rights, etc., were monumental. Learning the hard way, I conclude. Now Wimbledon or the All England Club proved everybody wrong when they purchased and paid pandemic coverage. Whether today you could secure pandemic coverage as we speak, I doubt it. No insurance company will be willing to offer that cover today, at least if it's related for the existing to the existing conditions of COVID-19. That is what I call the first part briefly. The second part, very quickly, in the second part, I decided to explain to you how directors and officers liability insurance operate. But this is not an insurance per se session. It will be very ambitious on my part to explain this in 20 minutes or so. So this is very basic. These D&O insurance policies could be very simple documents covering basic D&O insurance. The board of directors could be a super cover embedding within or amalgamating within one policy several other aspects. You can see on your right-hand side, for example, at 10 o'clock you find cyber liability. At 4 o'clock or 5 o'clock you find POSI coverage, public offering of securities, errors of omissions, and so on. So it could be a very basic document, could be a very complex one, including pandemic, if this coverage is negotiable within this type of insurance. D&O insurance was developed to protect directors and no companies. If companies want to protect themselves, they need to purchase different insurance products. It comes or stems from liability insurance the same way. It works very similar to what a third-party insurance or motor insurance would work. That insurance will cover your liabilities for damages you cause to other drivers. The same principle applies here. Cover directors' liabilities for damages they could cause to companies and even other stakeholders. Insurance companies pay when that liability is ascertained. Is claims-made policies. If you want me to explain what a claims-made policy, please ask me in the Q&A session. It's slightly complicated at this stage. And there are exclusions. Willful misconduct, fraud, etc., as a matter of public policy, cannot be covered under insurance law. It does cover regulatory investigations, and a stock exchange commission investigation, for example, is covered. And this is one or two of the examples I brought today for you to look at. There are three types of covers, A, B, and C. Side A covers directors' liabilities. Side B covers company reimbursement, which means monies that the company has indemnified the director. And side C is called entity cover company's liability itself, especially in cases of class actions regarding securities regulations. And it does cover defense costs. Somebody has described to me a D&O insurance policy without defense cost cover, a piece of paper that worth nothing. In fact, defense cost is what directors and officers look at when they enter into these type of agreements. There are some exclusions, some negotiable, some general exclusions as a matter of public policy, fraud, deliberate breach of duties, etc., and some more specific to this sort of insurance, like personal injury, product liability, professional liability, etc., because those liabilities are the subject matter of a specific insurance products. You could negotiate some exclusions. That means, for example, prior acts, retroactive cover, discovery periods, pollution, and I put there pandemics. This is excluded in the first place. However, for the right price, I believe insurance companies would agree to cover the pandemics and the effect of any pandemic or that any pandemic may have as affecting companies, directors, shareholders, stakeholders, final customers, etc., etc. Before I embark on the main mission of this presentation, I just want to highlight some features of the UK legal system and distinguish to a certain extent with other main jurisdictions. Because directors and officers liability insurance has been developed to protect directors' liabilities in the first place, it's important that we understand that that liability arises for directors breaching the duties they owe to the corporate body. According to our Companies Act and Section 170, the duties are owed the director to the company alone. That means that the proper claimant when directors breach duties is the company itself. Directors do not owe duties to shareholders. Directors do not owe duties to stakeholders or consumers or outsiders. They only owe duties to the company. Consequently, when a claim is made under directors and officers liability insurance, the claimant is the company claiming against the director who has allegedly breached a duty which caused some damages or losses to the company. However, not all jurisdictions operate equally. In New Zealand, for example, and most Latin American and European jurisdictions, directors owe duties to the company, shareholders, and even creditors. And that has a dramatic impact in directors and officers liability insurance risk, because the risk is much, much wider, much larger outside the United Kingdom, when it is only in exceptional circumstances when directors could incur liabilities to third parties personally. And this is in exceptional circumstances. Another very important difference between the United Kingdom and, for example, Australia, US, Germany, India, and so on, is that we do not have class actions. We do have representative actions, but no class actions per se. Class actions are brought, initiated in the United States on a daily basis. We don't have it. The closest we get to a class actions is a representative action. And in fact, at the end of April this year, I think it's the 27th or 28th of April, the United Kingdom Supreme Court will be entertaining a claim, a representative action, whose parties are Lloyd and Google, LLC. There is a claim, a representative claim, concerning the breach of data, data protection, and whether or not some could gather and get together and claim as a group of people, just for information purposes. I have then covered the basics of COVID. I have covered the basics of insurance, how the insurance is responding, and the basics of D&O insurance policies and directors. Let's align all these events: corporate boards, COVID-19, and directors and officers in general, and directors and officers insurance. These are the exposures that directors are facing as we speak. All the vast array of cases that I have looked at belong to one of those areas. There are claims against directors because directors have not promoted the success of the company in breach of their duties. Some directors in some companies have manipulated the accounts. For example, manipulating the filing of accounts with the regulator, the financial regulator, have dressed up accounts, or have misled investors with inaccurate forecasts. Some directors are facing liabilities for carrying on trading during the pandemic, leading to insolvency scenarios. But here, I need to make a stop, because there is a bubble there in red talking about the aftermath. The UK government, fully aware of what the impact of lockdown could be on businesses, and in the absence of solid and suitable business interruption insurance, decided to pass one act. The act is called the Corporate Insolvency and Governance Act 2020, which aimed at suspending the effect of wrongful trading as from the end of March 2020 until the end of September, originally 2020, but it has been extended until the end of April 2021. That means that during the suspended period, courts cannot assume that directors have worsened the financial situation of the company by carrying on trading during the pandemic period. Wrongful trading is a sort of liability that directors could incur if directors ought to know that the company is insolvent, nevertheless carry on trading on company's behalf, worsening the financial situation of the company. And this is one scenario when directors could incur personal liability for the larger loss costs in insolvency scenarios. Well, I'm telling you that this effect is being suspended, but I call in that bubble, I am warning the market, the aftermath. And the issue, as I see, and this is probably one of the most important issues for the corporate lawyers here today and corporate students, is the link of causation. If it's true that directors may not incur liability within the suspended period, what will happen if what causes the insolvency of the company after the end of April is something that directors did within the suspended period? Does it mean that because within the suspended period they were not liable or could escape liability, the chain of causation is broken? cannot we attribute that loss to that event which happened within the suspended period? Or on the other hand, the link of causation will remain intact in the sense that what we suspended, as interpreting the law, is directors incurring liabilities, but we cannot suspend or we cannot break the chain of causation because those acts, which could even be reckless acts beyond negligence, could actually cause the insolvency of the company after the end of this suspension. No doubt, directors are going to use the chain of causation issue in order to avoid liabilities for these claims. Why? Because recklessness and even fraud leading to a different type of liability could actually defeat any claim in insurance. Insurance companies will not pay indemnities. Other type of exposures are conflicts of interest and secret profits, and I brought today one specific example, and you will see why. And negligence. But negligence claims come in three different ways or categories. Companies could allege against directors that they did not secure proper cover. Why we don't have pandemic cover? The director is being negligent in not securing pandemic cover. Directors have been negligent in not filing accounts properly or timely. Directors could be liable for acts or omissions, and those acts or omissions regarding COVID could be no response to COVID, late response, or inadequate response. One of the case studies that you will be looking at later today refers to one company who exposed passengers and crew to COVID-19 without taking measures to prevent the virus or to stop the disease with affecting the clients and members of the crew. Negligent acts. Is that negligent act protected under the insurance policy? Is the question. These are the claims which I have seen maturing in courts, especially in the United States. We have class actions, but class actions coming in two different directions. Pharmaceutical companies developing COVID-related tools, vaccination, tests, etc. Internal claims, company claiming against directors for not performing their duties accordingly, and pharma companies facing external claims. People investing in pharmaceutical companies which may have misled investors as to the effectiveness of the vaccination, the test, and or the accounts. We have derivative actions, and derivative action, corporate students would understand that is the way that shareholders claim against directors for breach of the duties they owe the company. We have claims coming from employees, members of the crew in a line cruiser. A specific example are claiming against the company because the company directors exposed the employees to the virus without offering employees adequate protection. Securities regulation investigations leading to DPAs, which means Deferred Prosecution Agreements, and that is another neuralgic area in COVID-related matters. When companies breach financial regulation, the financial regulatory authority could prosecute the company. But the financial regulator could enter with agreement with the company and say, okay, do you admit liability? If you admit liability and you pay a fine, I suspend prosecution. And the company enters into a contractual relationship with the regulator, and the company promises to fulfill certain rules or meet certain requirements. One is dismissing directors from office. Deferred prosecution agreements and investigations are maturing into claims, and even other stakeholders. And you will see I have brought a clear example in this specific area, all the stakeholders claiming against companies for what companies have done. I say companies and or directors allegedly have done. Claim example number one. Now let's use whatever I have said and put this into perspective. Service Lamp Corporation Profit Sharing Plan and others against Carnival Corporation. This is a claim alleging violation of federal securities law. Now, please read the note at the very bottom of the slide, as any lawyer would do. I'm issuing a disclaimer. So I'm not assessing the merits of the claim, I'm just reporting the allegations made in this particular case. Carnival is a large leisure company and it has 104 cruise ships. It's very large. And there are allegations against Carnival because Carnival was trading its stock at a very high price after misleading the market. And that misleading statement referred to, for example, that the company was following health and safety protocols when the company reached ports of call regulations. And the reality is that the company, during that relevant period, knew that members of the crew and passengers had the virus. Nevertheless, the company carried on trading and even concealed those infected people to the relevant authorities. Of course, what happens in the market when you purchase at inflated price the stocks and then it transpires that the company has breached port of call regulations or COVID-19 protocols, that the price of those stocks fall. Consequently, we find or we face, or the company is facing, class actions and securities regulation class actions. Why? For the losses sustained by investors. The wrongful act in here is alleged to be misleading the market. After telling that the company was following the protocol, the company wasn't. After telling the market that everything was in place, but the reality is that it concealed information. Example number one, and this is other stakeholders claim scenario. The second, now we are dealing with pharmaceutical companies who embark specifically on dealing with test platforms and vaccines, COVID-19 vaccination protocols. Insergate, Chernished, and Chembio Diagnostics and others. Chembio, this is a class action and involves several areas of law, securities regulation, COVID, fraud, etc. Chembio patented a DPP technology platform. It's a dual path platform. And this platform uses a small drop of blood for your fingertip. And it says, or it said, that it provides cost-effective results in 15 minutes. This is a quote taken from Chembio's old publication. It says that Chembio meets the highest standards for accuracy and superior performance to help prevent the spread of infectious diseases, and that its innovative solutions like Chembio Dual Path Platform DPP made the point of care testing faster, more accurate, and most effective. Of course, if a company discloses that information, the stocks go up in price. And the company managed to sell that stock at an inflated price. The company also publicized that Chembio's serological antibody test was one of the first tests authorized by the Food and Drugs Agency in the United States for COVID, and also said that it was 100% accurate. Of course, the prices were even more inflated. Even though Chembio obtained license by the Food and Drugs Agency in America, that license was later revoked when the FDA discovered that the information provided by Chembio was inaccurate misleading, and it was, in fact, the test was not, in fact, 100% accurate. When the Food and Drug Association Agency publicized that information, the stocks declined, therefore, class actions against the company for misleading the market as to how accurate the test was. In other words, the allegation is that these companies tried to take full advantage of the COVID-19 situation and profit from it. Example number 3. Securities Exchange, that this is a financial regulator claim against Canal, president of Argit Corp. This company was contacted periodically by the Securities Exchange Commission and even shareholders, asking about whether or not the company had filed accounts with the Securities Exchange Commission. And the company reassured the investors that the financial reports have been prepared and the filing was imminent. Argit is a biotechnology company. However, Argit, the biotechnology company, knew that the financial statements were never ready. So they made false and misleading statements about not only the COVID test, but the filing with the Securities Exchange Commission. This case is slightly different from the previous one. The previous one, the company alleged that it was selected by the government, but in fact it was, but the license was revoked. Argit, on the other hand, misled the investors by saying that it has been chosen by the Food and Drug Agency and in fact never applied to be part of the program. So the case, I believe, is worse than the first one because the company never applied to be part of this program. When this information transpired, the stocks fell, then you find the Securities Exchange Commission class action and financial losses. Once again, companies taking advantage of COVID-19. The last one, before I draw this to send and open the doors for the floor for some questions. This is the case that really catches my attention. In the 25th of July 2020, the New York Times published this article or this report. Corporate insiders pocket $1 billion in rush for coronavirus vaccine, and that is the link. This case developed into a derivative claim, and the parties involved are David Stakowski of Vaxart Inc. and Stephen Boyd for Armistice Capital LLC. These are the facts of the case. Vaxart is a clinical stage biotechnology company developing oral vaccines, so it's quite connected to what we are facing at the moment. And Armistice is a hedge fund which happens to be the majority shareholder in Vaxart. But Armistice and Vaxart have something in common, and that is that one director and the founder of the hedge fund is also a director or are also directors in the board of Vaxart. These directors caused Vaxart to publicize that they were working on the vaccine. At the time, the United States Department of Health have developed what they call the OWS or Operation Warp Speed program, and the Parliament approved $10 billion to choose companies to produce 300 million vaccines. Vaxart, even though it applied to be part of the program, was never chosen. Nevertheless, Vaxart publicized and misled the market by saying that it was one of the companies selected by the OWS program to produce part of the 300 million vaccines. But look the beauty in this case. Now put yourself mentally in two situations. Before the company publicized that it was part of the program and what happened once the company publicized that it was part of the program. In yellow, for you to see how scandalous this could be. Before Buckingham announced that it was part of the OWB program, Buckingham gave the majority shareholder, Armistice, the right to purchase at 30 cents of a dollar up to 1/10 cents of a dollar shares in the region of 21 million. Also gave the chief executive officer, who was also the founder of the hedge fund, the opportunity to acquire 1.7 million shares at 2.46 of a dollar, worth 4.3 million, and other members also received stocks. Then the company publicized and disclosed to the market, hey, the government, the OWS program have chosen us. Look what happened with the monies. The 21 million became 197 million. The 4.3 million, 28 million, and so on, by telling tales according to what is alleged in this case. No doubt there are actions for insider dealing, bearing in mind that Buckingham is a public listed company. There are breach of duties, secret profits, and so on. And it's obvious that this, if this is accurate and this allegation happened to be true, these directors took full advantage of the pandemic to make millions of dollars at the expense of innocent investors in the market. Whether or not these four scenarios are covered under directors and officers liability insurance depends upon the nature of liability. If what happens is negligence, of course it covers. But a case like this one is obviously outside coverage because it's very intentional. It's a criminal act. However, investigations by the Stock Exchange Commission and so on, those regulatory investigators could be covered, but they come with a caveat. If the director is found to be criminally liable, then the director will have to reimburse the money to the insurance company. And the insurance company will probably face directors' insolvency, but that is a risk that those financial service providers face on a daily basis. Conclusion. There are several areas that I could refer to, but I will concentrate on 12 o'clock, and that is the reason why it's in red. Corporate social responsibility. Let's divide companies in three large groups. What is the social responsibility of a company unconnected with the manufacturing of vaccines or tests or pharmaceutical activities? What is the corporate responsibility of companies within the pharmaceutical area? What is the role or the corporate social responsibility of insurance companies insuring these events? Very difficult to predict, but I'm going to speculate here. Companies owe social responsibility to the public at large these days. The appetite for profits needs to be controlled because society is facing unprecedented events. I'm not suggesting that we should not take or could not take advantage of innovative ideas or the market disruption. In fact, disruption proves to be very profitable in the past, but we need to be very modest. And that is my advice. Companies need to be modest because everybody at every single level is suffering the consequences of the pandemic. And this is my message to companies at large. Pharmaceutical companies may need to, and this is a personal view, may need to be more, I would say, the voracity behind the making profits needs to be controlled because they also need to contribute to what society is experiencing. Just imagine the program in the United States when $10 billion in principle were approved in order to produce 300 million vaccines. That will come with an incredible large bill, invoice at the end. But profitability or the social aspect of the service they are provided needs to outweigh the profitability. That is the contribution that these companies need or should give to the society at large. They owe us that because we all need from each other. When I look at insurance companies and how they should react to COVID-19, I'm putting in a very difficult junction because insurance companies are not charities and they're there to make money for shareholders in those companies. However, insurance companies need also realize that if they fail and they deny indemnity to certain claims, that lack of indemnity or rejection would cause those claims to go bust. Clients will go bust. Business will disappear. Disappearing business means less insured people, less business to insure. So by reflection, lack of indemnity, rejections for no reason, or being not as lenient as we expect may cause insurance company face losses. Not losses for claims made, but losses for lack of clients purchasing insurance because less businesses will be operating. And that puts on insurance companies also pressure because they also need to face and contribute socially to what we are facing as human beings worldwide. I really hope that I have managed in 49 minutes to cover what I wanted, or the message I wanted to convey with some numbers and how I perceive the market is reacting. So thank you for your time. And now I pass on to Patricia in case we have some questions, and thank you for attending.
Thank you very much, Adolfo, for the presentation. And indeed, such an insightful situation, which was a little bit surprising for me about the different jurisdictions and how every jurisdiction approached things differently. And you covered the European market, the Latin American market, and gave examples of New Zealand and Australasia. So thank you very much for that. So I do have a question indeed. In your experience, because you were talking about different markets, do you see an increase of claims here in United Kingdom?
I do. There was a decision. I mentioned this during the presentation. Last week, the Supreme Court decided a case leading with actually covering the issue of link of causation, COVID, business interruption, and so on. I expect the market to face claims. Those claims are maturing. They are coming. Some companies are going to face insolvency, and claims under these type of policies are coming. However, we need to understand that the majority of these packages offered to big corporations contain arbitration clauses. Therefore, it's very unlikely that we see claims like of this nature in courts. They resolve internally by ADR or arbitration. But I'm privy to information telling me that these claims are coming because we are dealing with some as we speak. I don't think we are going to courts. They are going to be settled, but the market is experiencing large claims. I don't think the market capacity is a problem. I don't think the market lacks capacity to respond, but responding to these claims will impinge on in future portfolios. So what we will see is an increase in premiums for the years to come in order to make up the losses sustained by large insurance companies. The reinsurance market will face liabilities probably even in the long term, because we need to resolve the insurance claims first before moving on to the reinsurance market. I give you another case, and it's totally unconnected with today's discussion, by the Suez Canal blockade. Okay, the Ever Given container who blocked the canal last month or 2 weeks ago is giving rise to a $900 million claim as we speak. And the Egyptian government is claiming 300 million for damage to their reputation. And that is what the insurance companies are fighting as we speak. That claim alone, and it's unconnected with COVID, is 900 million. Now, if we add that to the claims coming for business interruption, D&O, and several others, like product liability, including, and I don't want to be too negative, including potential claims for side effects of vaccines caused by vaccines, which is also part of insurance coverage, then yes, the market may face some challenging times.
Thank you, Adolfo. I'm building upon that. You said that you expect to see many claims regarding this issue, but that's where companies already have that insurance policy. So would you expect then for companies to acquire insurance regarding directors' liability?
Well, they would have to negotiate tail cover or retroactive periods and so on. But as I said, Shop, for example, is taking a very hard position. They're saying, well, we renew products, but we are not improving the policy. Okay? So we can offer a more expensive product for exactly the same coverage. But soon, I'm very confident in saying that the day when directors would realize that D&O insurance policies are a must-have product is coming. The level and the sort of liabilities and the extent of liabilities that directors may face, or being directors of companies, may force directors to purchase these products. These products are inexpensive as we speak. Okay, you could secure for a couple of £1,000 very good cover for 5-10 million pounds coverage, individually speaking. Okay, I have seen programs where the D&O insurance policy is a £2 million premium because the company is very large, etc., etc. So the exposure is very large. But the day when soon the day will come when we realize that this sort of cover is a must-have cover for directors and officers, including pandemics, because we learned the hard way. And probably Wimbledon Tennis Club, the organization, is telling us, sorry, we need to be prepared for the unforeseeable. And that is exactly what Wimbledon told us. We learned the hard way.
Thank you, Adolfo. I'm building upon the first question regarding the expectations to increase claims. There is an excellent question in here made by Jay that asks, when do you believe companies will start to make these claims? You know, once the economy has reopened or once the pandemic has disappeared?
Several have already started. Okay, business interruption insurance has been triggered already. I believe that claims, because the limitation period has not started yet, because we're in the middle of the pandemic, then companies may quantify first what the extent of the losses is before making claims. However, I mentioned earlier that one of the features of D&O insurance is that they are written or underwritten on a claims-made basis. And claims-made means that the insurer needs to notify the insurance company of any situation likely to give rise to a claim. It's not the claim itself, but situations that may develop into claims. If that notification is made, the insurance company is put on notice and the insurance company will have to respond. So we are not looking at ascertaining liability. What we're looking at is notifying claims to trigger coverage. That has taken place already. I understand that has taken place already, so claims have been made. Now, quantifying indemnity is what is unknown.
Thank you, Adolfo. And let's take another question, and the last one due to time. So I can see that we have an anonymous question that says, also, is there any monopoly concerns for the biggest two insurance companies to merge? Or because of COVID-19, is that easily justifiable?
Well, first, there are no insurance companies. Aon and Willis Towers are brokers, okay, intermediaries. But there are issues of competition law. FinPro, for example, needs to be detached from the merge because it's just too much control of the market. I think, and this is my very personal view, that the reason why that merge has not happened is because they have been unable to convince anti-monopoly authorities. They're just too large, and they will be controlling, well, in one sentence, they will be the most important, the largest broker in the world. No company will be as large as that one providing brokerage services. But the United Kingdom market is particular, and that is the reason why the merger is taking place here. Because Lloyd's Corporation, Lloyd's Insurance, offer insurance products, but Lloyd's cannot deal with insureds directly. If you want to place insurance Lloyd's, you need to use brokers. And that is the pivotal role that brokers play in the United Kingdom. You cannot place directly insurance with Lloyd's. So brokers, the brokerage of these products is actually a seriously profitable business. But we need to think very large, okay? Very, very large. A very simple package offering umbrella cover for a company could lead to 5, 6, 10 million pounds premiums. Okay? Very complex documents, very large, complex, containing different sectors and different bundles. And these are prepared by brokers. Now, would Aon and Willis be in a prominent position of imposing some lines of businesses? Yes. Why? Because another feature of the UK market is that the regulator does not approve policies. The policies are written by brokers. So the broker sits down, asks the client, what do you want to insure? And then the broker prepares a proposal, a document, and that document is underwritten in the market. So the regulator does not even control the content of the policy. It's pure contract law. If they control that section, a big section of the market, then they will, I believe, they will be dictating some rules and forcing insurance companies to undertake on Aon Willis terms insurance. Probably that will be the case.
Thank you very much. And for everyone, the video stream will be available to everyone in the University of Buckingham. You need just to check Microsoft Stream later on during the week for you to have access to this. Thank you very much, Adolfo, from me, and I pass now the floor to Sandra.
Thank you very, very much, Adolfo. That was really interesting. I was fascinated by the farsightedness of Wimbledon in taking out that insurance, and it'll be interesting to see if that claim gets paid out. And all the others, like Roland Garros, will be sitting there cursing that they didn't have the same farsightedness. Thank you also so much to Patricia for moderating the questions so well, and also, of course, Adolfo, for you for answering them. And thank you very much for all of our audience here for asking interesting questions. And I'm sure you will all agree it's been a really great lecture, and we've all learned a lot about insurance that we didn't know before in this difficult time. So thank you very much, and goodbye to everyone.